So here we're going to turn to Asia, and we're going to start off with China and some of the key pieces that I think are important in terms of where things are going and the likelihood of stimulus. Because we've heard a lot about stimulus, we've heard the rhetoric, we've heard the views, but what is the actual capacity of them stimulating? And I think that's a key piece that we want to touch on as we go forward. So first, when we look at the PMI composite from the Caxton, you can see that last month it was 37.2. It improved in May to 42.2. PMI services was expected to be at 46. It came in at 41.4. Now, the manufacturing was better than expected. So you had manufacturing going up, services missing by a country mile. And I think this really defines the problem in their economy right now. Because when we showed previous pieces on some of the underlying data, the consumer just isn't spending. And there's a lot of concern. They'd rather save because the uncertainty of, are we going to have another lockdown? Are we going to have jobs? There's a lot of fear in the system, which is, I think, really freezing people up. While manufacturing, there's still back orders, there's still some activity. So that is going up. It was still contractionary. There you go. But it wasn't to the same level. So overall, the composite is still very problematic given where things are. Now, exports were expected to be at 8%. They were at 16.9%. So again, a positive move going forward because there was that backlog. Imports missed. Now imports was supposed to be up 2.8%. They came in up 4.1%. Now, that's good because it beat estimates, but the wide differential between exports and imports is a problem for going forward, and we're starting to see a big increase in Chinese inventories, which again leads to the bigger issue of there's a lot of slowdown that is happening in the services buying, in the local buying, but there's also that slowdown on exports, which again is kind of that crux of why we see so many problems in the underlying economy, because exports won't be able to save them the same way it did in 2021. Now, when you start looking at well-stocked shelves in the U.S. Real inventory, so retail trade industries, excluding motor vehicles and parts, when you get an idea of the pre-pandemic trend and where inventory is in the U.S., which is, as we've been talking about and as we've shown in the Chinese data, new orders and new export orders were negative in China prior to this lockdown. So they were already seeing these pressure points. And now when you start looking at revenue, the general public budget is steeply negative and the government managed funds negative. So you're seeing that they want to stimulate more, but fiscal revenue has dropped precipitously, and it's not getting any better based on where things are when you start looking at the exports numbers and the other leading indicators. Which again, with what money? Because they've been stimulating so much, borrowing so much, how are they going to continue to move this forward? Which is why when you start looking at, okay, well, you're going to have the provincial governments issuing special purpose bonds, but government land transfer revenues is contracting, and it hasn't been positive. It ticked positive real quick in 2021, but now has been steeply negative through the end of 2021 into 2022, moving further down. And this is a key way of how provinces and local cities have been earning money. And now, so you're asking them to lend more, but some of their key means of making money have gone away. We showed the fiscal budgets, which are steeply negative, and now this is another bigger problem. So then the mounting product inventory. So when you look at the finished good inventories have gone up and are now expanding, while input inventories have come down. So that's the input inventories have been drawn down, but the finished good inventories is growing. Now, this could be a little bit of a snapback if you think about at post reopening, but we see a bigger issue and trend that is going to be in a contractionary standpoint, given the slowdown, not only in exports, but really local consumption and the problems that we're seeing, which is why the inventory is going to get worse because we don't see locals spending the same way. And then when you look at industrial corporates, product inventory is now up 18% year over year on an annual change basis. And you can see it's only been increasing since 2020, putting more longer term pressure on their underlying economy. So the fiscal revenue in free fall. So you look at central government is negative, local government negative. So, but you want them to stimulate, but then you look at it and say, okay, well, we're cutting taxes, but we still have a decent tax revenue. So you're cutting taxes, but the leading indicator on corporate profits. So corporate profits are also moving down. So even companies that make money are going to be paying less in taxes because they've made less money, and they're also going to get tax incentives. So again, you're seeing this pressure point getting much worse on both the central government and local government level as we get these corporate leading indicators and these forward earnings per share, profit margins all getting squeezed. So there's going to be a matter of you're already cutting a revenue base from a shrinking revenue base, which is just going to make your shortfall that much worse. So then when you put into perspective the different spending trends, so the China service PMI, as we said before, coming in at 42, the non-manufacturing PMI coming in at about 47. So this is kind of the tale of two cities that we're seeing, with the services more reflective of local consumption, and that's where we see some of the pressure points. And here is another little tidbit on timing. So spending data from the 3-day holiday weekend, which was the Dragon Boat Festival, showed a slump in domestic tourism revenue of 12.2% from a year ago, a much narrower drop than the 43% plunge recorded a month ago over the National Labor Day holiday. Obviously, one had a lockdown, one had a bit more of a reopening. The 10.7% decline in trips over the period was also smaller than a 30.2% decrease reported over the May holiday. The modest drop in tourism spending suggests a recovery is underway. But when you start looking at also expecting improvement in headline activity growth indexes and the rollback of restrictions, the sentiment carried over the stock market, which is what we saw that big increase. But when you look at the pace of it, you're starting to see that you had a nice increase, but the services side stopped. You didn't get the same type of follow through that you would have expected from the non-manufacturing PMI, which is pointing to a bit more of the problems that we're starting to see. And this is looking at it from a little bit of a different perspective, because the survey was for 46, but for 41.4. But the services PMI employment is, I think, a bigger problem because there was no bounce. Instead, it went to 48.5, so it went steeper into contraction, which again is that leading indicator to, well, if employment is contracting, do I need to be more concerned about how much I'm saving versus spending? And that's when you start to see that slowdown in terms of what that recovery of the service sector is going to look like. Offshore defaults by Chinese corporations, non-SOE default amounts continue to grow. We see that continuing to be a big issue in general as we look at non-SOE, which is why you're seeing a lot of that pressure, and we've had a continuous push down and pressure on some of this debt. Now, China's offshore bond defaults have topped their prior full year high. So far in 2022, we're only in June 9th. We've already seen it take out the 2021 highs. So that is why we continue to see problems. But how do you get in front of these defaults? And again, the cumulative local government special purpose bonds, the SPBs, have continued to outpace 2020. But the question is going to be, how much can that continue? Because you're starting to see that flat line, and we don't see that pickup, not because they're not trying to put more supply out there, but the demand structure is the problem. Because if you're a corporation, you're seeing profit margins go down, you're laying people off, you're seeing pressure on the export market. Why am I going to go borrow more money and increase my leverage and the underlying pressure? Looking at this in a different way, China's cement outlook indicator continues to be negative. And again, the cement indicator is just one way. Steel production, you can see, is below what it was in 2019, 2020, 2021. As the local demand still just does there, and this is again leading to the borrowing, the inflationary pressures. We're just not seeing the activity that we should be seeing, especially to make up for the shortfalls, which is why we think there is a huge amount of risk on the expectations of economic growth within China. Then taking that to the next level, when you look at road traffic, you can see that there has been a bounce, but it is still well off of normal on the 7-day rolling average. It has gotten a bit better, but remember, there was the holidays, and we expect this to remain a bit underwhelming. As domestic routes passenger flights continues to be negative. Now, even though they're reopening the country a bit, they're still trying to keep people from moving too far around because, again, they don't want another outbreak. They don't want this to spread further. So that's where you're starting to see some of these flights remaining canceled, putting a bit more pressure on what their oil demand will look like. Supply side disruptions are easing more slowly than in 2020. So when you think about the pressure that they're seeing, they're also looking at the issues they're having internally. Because of the uncertainty on the reopen, you're not getting a lot of things moving through. You're not getting the reopening on the roadside, the highway system, because they're also dealing with Omicron and the more contagious variants. So again, there's that reopening. The supply side residual abstracts away the demand driven change in delivery times by using a regression against the new orders index. So that's when you start seeing those pressure points, which we think is going to impact inflation more internally and put more pressure on local spending. So then when you start turning to South Korea, the survey for CPI was expected at 3.7, came in at 4.1. Investment has continued to contract 3 months in a row in South Korea, and the central bank has raised rates again, trying to get in front of that. And we're starting to see, again, South Korean exports are still positive. They're still strong. They're just slowing. And that's more of a leading indicator for where things are going, because South Korea typically imports from China semi-finished goods from ASEAN nations, and then exports the final. And as their final products are slowing, that typically means that the residual, those semi-finished goods, those won't be purchased. And you can see how there's that knock-on effect that continues to go through the supply chain that we expect to accelerate. Now, when you look at global ASEAN manufacturing, you can see things have flatlined. We think that there's pressure to the downside, but still expanding. We're not talking about some steep decline, but more along the lines of going from a 53 down to a 51 as you get some of this contraction and playing out, and again, leading to a bit of a bigger slowdown. And you're seeing it here with the Asia sector PMI business activity. You're seeing that automobile and auto parts slowing, machinery and equipment bouncing, but again, staying a bit depressed while insurance has gone up. But the underlying crux of activity still remains negative, which again is they're still living off of some inventories as business activity, but as activity slows, you live off of inventories. But as you see exports slowing, internal demand slowing, inflation going up, wanting to minimize locking in higher prices and inventory, that's where you're seeing the pressure. India's already raised rates. You're seeing more of those pressure points. When you look at the value of exports, in some areas it's gone up, but it's still below estimates, which is showing more of a volume problem, which we're seeing play out when we look at the whole numbers in terms of volumes of global trade, because a lot of it really originates in Asia, which is why the problems are going to continue to persist. So that's what we have for you today. If you have any questions, you can find us in the comments section or again on Twitter. We welcome your feedback. Please like, share, subscribe, because your support is appreciated. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.